Today, the inflation genie still worries the EU. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the Eurozone inflation number came in a little bit below expectation on Thursday, but it's not yet apparent that core inflation has peaked in the Eurozone, according to the European Central Bank President Christine Lagarde, who pledged further increases in borrowing costs. There is no clear evidence that underlying inflation has peaked, Lagarde said on Thursday in a speech in Hanover in Germany. We have made clear that we still have ground to cover to bring interest rates to sufficiently restrictive levels. Lagarde spoke shortly after data showed inflation in the 20-nation Eurozone slowed markedly last month, reinforcing the idea that the toughest monetary tightening campaign of the Euro era can soon draw to a close. Core price pressures, however, moderated by less, meaning there's a probability of at least one more rate hike to come to ensure the 2% inflation target's reached. Speaking on Wednesday, the ECB Vice President Louis de Guiche warned that he could not say that the victory is there so far, and fellow rate setter Maris Muller said more than one additional quarter-point rate move was likely. Lagarde said officials aren't satisfied with the inflation outlook, but that monetary policy is being transmitted forcibly to credit, with the action taken to date to still have a significant impact. These hikes are already feeding forcibly into bank lending conditions, he said, and we know that having hiked so far and so fast, considerable tightening is still in the pipeline. So looking at the data in more detail, consumer prices, excluding items like fuel and food, advanced by 5.3% from a year earlier in May, down from April's 5.6% increase and less than the 5.5% estimate from economists. The headline gauge moderated more markedly, easing to 6.1%. That's the lowest level in more than a year, driven primarily by lower energy costs. The data included big slowdowns for the 20-nation Eurozone top four economies and will be welcomed by politicians and monetary policymakers alike as the continent's citizens struggle with the bruising cost of living crisis. But the stubborn nature of the core measure means ECB officials plan to extend their unprecedented tightening campaign in 2 weeks' time, despite Germany slipping recently into recession and financial dangers still swirling around the place. The development of underlying price gains was broadly seen as worrisome at the ECB's last meeting on May the 3rd and 4th. Investors and economists widely predict another quarter-point move on June the 15th and reckon there'll be at least probably one more to round off the cycle that brought deposit rates to 3.25 from below zero last July. Thursday's data actually didn't shift rate bets in the money markets, which already digested the nation's figures earlier in the week. Policymakers say bringing the growth in consumer prices back to 2% is essential to underpin economic expansion and financial stability, with both areas feeling the effects of rising rates. Germany's first recession since the pandemic underlined the vulnerability of the continent's largest economy, even after it spent big to shield households from soaring energy bills following Russia's invasion of Ukraine. And the ECB, meanwhile, warned this week that tighter monetary policy leaves financial markets at risk of negative shocks and are testing the resilience of households, companies, governments, and the real estate sector. The focus remains, though, on tackling prices, which involves not just raising borrowing costs but maintaining them there once they've reached their peak. Headline inflation may be coming down as we start to see the food and energy shocks dissipate, said Laura Cooper, BlackRock's senior macro strategist. But clearly, the services inflation, the core gauges, continue to show price persistence, and that does suggest that the ECB will have to keep rates in restrictive territory for quite some time. And this, of course, is the point, that in fact inflation can be eased back if the energy base effect works through. But the services inflation and the core inflation measures are still pointing in the wrong direction in many different countries across the globe. So the battle with inflation has a long, long way to go, which is why we also think that there'll be higher interest rates and a recession, and probably then rates cutting like mad, but that could lead to a recession and maybe even worse. So we are at a precarious stage of the cycle, but central bankers nevertheless are still fixated on slaying the inflation dragon. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.